Nostraland, Territonia, and Apparatonia. A fictional scenario regarding international taxation policy for developed countries. A presentation by Charles Edward Andrew Lincoln IV for developed countries OECD module by Professor Jan de Goede and Bruno da Silva. Now, the presentation will go on and discuss the implications for these three countries. Now, the three countries at hand are Nostraland, Territonia, and Apparatonia. So let's start off with Nostraland. So Territonia citizens will want to invest in Nostraland. Nostraland will want to invest in Territonia. This means that the Nostrian investor will invest abroad, and the Nostrian tax administration will need to give an exemption for this abroad investment for active income. Generally, in the past, Nostraland did not want to give lower PE thresholds, that is, permanent establishments thresholds, because then developing countries will want to start as well, and we are in a dilemma how we get away with that. The question is there a way to compromise? The implications for Territonia are that the residents of Territonia working in the Nostraland will be confronted with PE issues, jurisdictional issues, and additional levy of resources. We're going to get to those three issues post-tense, post-taste potatoes. But only on the continental shelf, and that implies another jurisdictional issue. So when we'll have to deal also with the credit system. Now, continuing on, we'll look at Apparatonia, who in some sense has solved the permanent establishment threshold because it only has a 12-month threshold for permanent establishments, but it applies to any exploitation equipment. So, there's a PE level, but exploitation is not excluded in that scenario. So there's a different type of thresholds with substantial equipment test in this country, and it also uses a credit system, which would imply that it's a capital export neutral country. And this is because capital export neutrality implies that the country does not want to disincentivize investors from selling abroad. And in a capital import neutrality country, they would use the exemption system, which allows investors to import and not, preclude investment from abroad. So the jurisdictional issues are nearness of the countries and the continental shelf. So let's start off with the nearness of the countries. Now, this may sound like a strange term at first, but let's say we're in a fictional scenario. This is Territonia. But as we had stated previously, let's just say, for instance, that the Sopora case might be relevant. Now, the Sopora case stated that the free movement of workers does not preclude legislation of a member state of the European Union granting incoming workers who prior to employment in that member state resided in another member state at a distance of 150 kilometers from its border. Now, if you remember from the Sopora case, the Netherlands and the UK do have certain areas of their country that are within 150 kilometers of each other. So, considering that, it's a flat exemption on reimbursement of extraterritorial expenses. So that means that another member state is not exempted for providing exemptions for reimbursement of extraterritorial expenses while granting such an exemption to an incoming worker who resided less than the distance from the border. So, unless that exemption systematically gives rise to a net compensation in respect of the extraterritorial expenses actually incurred. So this is something to consider, that there could be agreements within a consolidated economic and internal unity that implies certain taxation exemptions might occur. Now, let's go to the extractive industry life cycle. Extractive industry life cycle is basically you get the right to mine the area. Now, this can happen in two ways. You either get a license or you get a contract for royalties, and that's in a common law country. But here we're specifically dealing with civil law countries in which you would be gaining a license through the government, and then that can create a venture. And then you sign the contracts, you explore, you develop the infrastructure to extract, you extract, and then you start abandoning and decommissioning. Now, this is not including the marketing and selling side at the other end of the chain. Now, looking at this, we look at reducing the possibility of reducing risk through joint ventures. This is going to become important for the PE threshold and outgoing and incoming investment. But the United Nations has stated that it's a very risky business for several reasons. One, the business is risky because you're not sure if you're going to maximize or even actualize profits in any given amount of time. The investors will often seek to reduce risk via project diversification, often through cooperation and through joint ventures. Now, what a joint venture would often look like in the past is a government-sponsored activity. But once you've achieved the license, you can have government regulation being a co-joint sponsor, but you could also have other types of businesses, other mining and oil and gas extractive industries coming in with you. So the investors, how will the investors be treated in the companies? The question is, how will the license holder be treated while doing the exploitation? So the person's doing the exploitation could be the investor, and it could be contractors. But what I suggest is that we bifurcate the investors and the subcontractors, thereby having a two-tiered system of extracting the oil industry off the coast of the Netherlands. Now, how would this affect the PE? There's several issues we need to discuss with the PE, but first, if we have a two-tiered structure, it could reduce the thresholds without even having to renegotiate that section of the treaty. But assuming that doesn't work, there would be broader policy implications for the PE threshold. Now, the issue is if we change the PE threshold in our tax treaties, then other treaties may have to change as well, especially with developing countries. Now, the issue is Nostraland has not wanted to change these tax treaties with these countries because the issue is that when we're negotiating with United Nations developing countries who follow the United Nations model, they often want to set lower thresholds for incoming profit for the source-based taxation, specifically permanent establishments, and this means it would reduce taxation in Nostraland and increase taxation abroad. Now, this is against the policy for several reasons. Now, one, we have a system of taxation that is more oriented towards the threshold. That's why I suggest we have a two-tiered system for investing, and that will provide us with a way to promote diversification in a number of ways. Now, continuing on, the possible changes to the PE and other treaties. If the threshold is not reduced, there could be another way of formulating a PE for combining time periods rather than just one period. So that means we're combining time periods given the short nature of the work. So rather than changing the threshold, we can just, given the short nature of the work, we can combine the thresholds effectively, efficiently, and promote maximized returns while reducing costs. Now, there's another Article 7 solution that we could look to the international, to the United Nations and the United Nations and the Organization for Economic Cooperation and Development stated that business profit solutions could even reduce the business profits by reducing taxation on business profits or increasing taxation on business profits and reducing taxation on the resource levy that occurs. Now, the resource levy possibly it could keep the PE threshold and increase the resource levy. So the purpose is to provide a corporate tax plus a resource levy. This is different from the royalties that are owned by individuals or common law countries. They receive some further revenue from the business, natural resource sector, and the scope is to provide derived from the activities of the net quantity produced gross. So the policy for a higher levy comes from a report in the United Nations that said, taking into account that they are assets owned by a country once extracted, they are gone, providing a return commensurate with the risk borne and the source country. So therefore, that legitimizes the resource levy. So can we change the definition of resource levies? That could happen by returning to private property, but that's a a large legislative leap with many implications beyond resource and mineral extraction. And we could change the definition of royalties from income of the license holders. Now, the treaty allocation for outgoing and incoming investment, they want to create a new tax for territorial income, which is either profit based or output based. Now, by having the two-tiered system, we could change the profit um, base significantly. I'm going to move this, and that'll be our guiding discussion when we talk about the life cycle of extractive industries.